Jamaica could soon see an end to US dollar prices. That is at least if the recommendations in the latest IMF country report on Jamaica are to be followed. The fund says the Bank of Jamaica can start stepping back from the foreign exchange market. In plain English, the IMF is signaling that Jamaica's central bank should spend less time propping up the Jamaican dollar and more time letting supply and demand find their own levels. So in this video, I'm going to unpack exactly what that advice means, why the IMF thinks that the time is right, the benefits it could unlock, and the risks that every Jamaican shopper, borrower, and exporter needs to understand. Now, as usual, before we dive in, a quick favor. I am pushing hard to get this channel to 10,000 subscribers. The more subscribers we have, the better the videos will eventually become. Thank you very much if you've already subscribed, but if you haven't, please go ahead and press that shining red button below. Right, the context. Over the past 10 years, Jamaica has pulled off quite a turnaround. You see, back in 2013, the government of Jamaica owed almost 1.5 times what the entire economy produced in a year. Today, that debt is down to about 70% of the national income. Inflation, the speed at which prices rise, has averaged around 5%, right in the Bank of Jamaica's comfort zone. The country has piled up foreign currency savings, big enough to pay for 7 months of imports, and booming tourism plus steady remittances even pushed Jamaica's external accounts into a small surplus. Because of these buffers, Jamaica survived last year's battering from Hurricane Beryl with only a tiny 1% dip in output. Growth is already on track to bounce back to a little over 2% next year, and unemployment is sitting at a record low 3.7%. Now, into that fairly upbeat picture comes the IMF's latest advice. Jamaica should deepen its foreign exchange market. In everyday language, they're telling the Bank of Jamaica to pull back from the day-to-day hustle of buying and selling US dollars. You see, right now, whenever the rates starts to wobble, the Bank of Jamaica steps in. If demand for US dollars suddenly spikes, say a big importer needs some cash, the Bank of Jamaica sells some of its own US dollar stash to calm things down. If too many people try to dump US dollars all at once, the Bank of Jamaica may buy them to stop the Jamaican dollar from shooting up too quickly. Why would stepping back help? First, it saves those hard-earned US dollar reserves for real emergencies like a hurricane or a sudden stop in tourism when we truly need them. Second, it tells credit rating agencies Jamaica now trusts its own market forces, which can lead to better borrowing terms. Third, it nudges businesses and households to think and transact in Jamaican dollars instead of always using US currency. Economists call that de-dollarization. The more prices, loans and savings are set in Jamaica's own currency, the faster an interest rate cut or hike by the Bank of Jamaica shows up in mortgage rates, car loan offers and credit card bills. In the long run, a livelier, freer forex market can lure new banks, regional investors and fintech firms to Kingston, creating jobs and lowering fees that Jamaicans pay when changing money. There are everyday wins as well. When shopkeepers list prices in Jamaican dollars and landlords write leases in Jamaican dollars, you can see exactly what things cost without a sneaky exchange rate cushion slapped on top. Over time, that clarity can squeeze out some of the markups. And if people believe that the central bank won't have to fight big currency fires every month, they stop guessing huge future price jumps when bargaining for wages or signing long-term loans. Now that is the upside. The downside is a bumpier ride in the short run. If tourist arrival falls or a US interest rate rise, the Jamaican dollar could slide faster than we're used to because the Bank of Jamaica is not going to jump in, at least in the first instance. So importers of petrol, medicine and machinery would feel it right away, and those higher costs would trickle down to Jamaicans at the supermarket and the gas station. If enough people fear the slide will continue, they may rush to buy more US dollars, making the drop even steeper. The Bank of Jamaica can still intervene, but the idea is to do so less often and only after the market has tried to find its own balance. Now, firms that borrowed heavily in US dollars could face even a bigger risk. Every 1% fall in the Jamaican dollar made those debt 1% bigger in local money terms, while their sales at home may not rise as fast. The IMF hopes that companies will protect themselves with hedges. Basically, insurance contracts, or they will borrow more in Jamaican dollars instead. But Jamaica's hedge market is still very tiny, and local currency corporate bonds are rare. So that shift will take time. Banks too will have to juggle larger currency swings on their books, and regulators promise to watch them like hawks. And that extra monitoring cost usually end up on bank fees, so customers will feel that as well. The IMF links this currency advice to two other big themes. First, it wants the Jamaican government to keep running strong budget surpluses, about 6% of GDP, until debt falls to below 60% by 2027-2028, then aim even lower. If ministers keep a tight grip on spending, investors will trust that any wobble in the exchange rate is a short-term problem, not a sign that Jamaica is living beyond its means. Second, the fund urges more structural fixes, faster customs, sharper banking competition, better roads and ports, and climate-proof infrastructure. Those upgrades could cut business costs so that when the currency moves, prices don't shoot up too quickly. So, what does this actually mean for ordinary Jamaicans? In the near term, you might see the dollar price on the Cambia board jump around a bit more. And anybody with a US dollar car loan might lose sleep on volatile days. But if the plan works, in a few years from now, Jamaica will have clearer price tags, more loans and salaries set in Jamaican dollars, and a financial system that serves Jamaicans in their own currency. The IMF thinks the key is timing and communication. The Bank of Jamaica must ease off the market slowly and make sure that the government keeps its own spending promises so that confidence doesn't evaporate. So after a decade of hard work, the IMF is basically telling Jamaica, you have earned the right to trust your own money. Now show that you can handle that freedom. Now, whether this gamble pays off will depend on how quickly exporters will learn to hedge, how strictly Parliament guards the surplus, and how calmly the Bank of Jamaica reacts when the next global crisis hits. Now, as usual, I'd love to hear your thoughts on this. Are you ready for a Jamaican dollar that is going to move a bit more every day, or would keep you up at night? Let me know your thoughts in the comments. And look, don't forget, I'm depending on you to give the video a like and make sure you subscribe to the channel if you haven't subscribed yet. Thank you, and I'll see you on the next one.